So no matter what happens, it's a shock to somebody. So the world consists of these disturbances, and our objective should be to think about consistent ways of explaining how the shocks are propagated through the system. Welcome back. This is lecture number 9. We're going to talk about the ASAT model. We're going to downshift a little bit and take it several notches down and try to show where the rest of the course is going. And I'm always of the opinion we need to give everyone something to take along with them for the rest of their lives. And this is one course, one lecture in the course that I think will benefit everybody, even if you don't like the math that much. What I'd like to do is set the stage for the rest of the course, which is thinking about short-run fluctuations. We've spent a lot of time talking about long-run growth and the trend, and now we're moving towards an understanding of the quarter-to-quarter developments like we're observing right now in the global economy, potentially a slowdown. Why would we expect that to happen? How does the macroeconomic system yield that result? And why are business cycles actually quite similar across countries and over time? Okay, so I'm gonna review last time, and I'm gonna spend a few minutes renewing or reviving that discussion of the Phillips Curve we had last time. It's kind of an amusement for you, but actually has a lot of significance. It's an example of using inductive reasoning to structure our thinking about economics, and then using theory later. In this course, we'll do that certainly, to try to explain why this robust empirical relationship seems to hold and why it may break down. And the fact that it broke down in the 1970s gave rise to whole new economic schools of thought and criticism, and then a convergence. Okay, so it's important to understand that this is like we're like any other science. We have challenges, we have empirical challenges, we have theoretical conflicts, and one way of understanding how economics makes progress is resolving these conflicts, resolving contradictions, recognizing that some of the data may not be consistent with part of the theory, and how can we change the theory to keep it consistent with its usefulness as a way of structuring our thoughts. Okay, so I'd like to appeal to something you've all had as an undergraduate, because your masters, and I know you've seen it somewhere, it's a very, very efficient way of thinking about macroeconomic events. Okay, so we're going to reduce the entire set of events into just inflation and output. And in particular, we're going to look at output as a deviation around its sort of sustainable trend. And inflation is the rate of change of prices, which we know in the long run has a lot to do with the rate of growth of monetary aggregates. But in the short run, anything can happen. Okay, and I'm going to use that as a springboard to start talking about a tool that will help us think about the rest of the course. And this is called, these are called stochastic difference equations. So we're talking about linear relationships of variables that are endogenous that relate them to other values of endogenous variables, some possibly exogenous variables, and randomness. Okay, and randomness is kind of a concession that we can't explain everything. If the price of oil goes up tomorrow, I can't tell you why it happened. If the dollar collapses tomorrow, I'm not really sure I could explain it either. I'd have to know more. And that's kind of what a lot of economics is about. We know that conditioned on the shock, we can predict what will happen, but we have to know that the shock has occurred. And there's a lot going on right now in the British Parliament that nobody can predict. Okay, so that's a shock for all of us. No economist can tell you what's going to happen in Parliament and whether May will be able to defer again a decision on Brexit. And they force her hand, they'll certainly change the history of Europe, and if she gets her way and negotiates with Merkel, we'll also have a different outcome. So economics helps us structure the way a system reacts to a shock. And a shock is by definition not predictable. So don't tell your parents you can explain the world, because you can't. Okay? Economics is not about explaining the world. It's about trying to explain consistent relationships using theory that's robust and consistent with individual behavior. Okay, so I will use this ASAT as a toy model to help you think about stochastic difference equations. And the last week of this year, this calendar year, I will use to show you what a difference equation is and how we can use it to think about dynamics. Okay, we'll use some complicated not really complicated, but some sophisticated math. And if you go on to do macroeconomics, everything you will be doing is explaining macroeconomic interactions as the result of interactions of difference equations, be they log linearized or be they nonlinear, other types of forms, okay? And I'll make an appeal to Eugene Slutsky's view of the way the world works. This is exactly what he said. He said, basically, you give me 2 dice, and I can roll them 50 times in a row and write down those numbers, and I can take moving averages of those numbers, and I can get a cycle. And I can get a cycle in a very systematic way, even though each cycle is a random variable. It's a realization of a random sequence of die rolls, okay? It's an interesting thought. Okay, so one way of thinking about the business cycle we have in Germany and the United States and Switzerland and Russia is basically accumulation of shocks. And the system of economic relationships is the cumulator. It's the way these shocks add up over time. We've already had a very easy example, which is investment. Investment adds up to capital stock. So if you have several successive good periods in investment, you're going to have a bigger capital stock. So you can think of the random shock to that relationship might be the random obsolescence of that capital stock. So that would be kind of like an easy way of thinking about a difference equation that is shocked in every period by a random variable. That's where macroeconomics in the medium run and the short run is going these days. It's been there for the past 50 years. It's the way we think about this. So it's a very robust summary of the way we reason, okay? So last time we finished the Kagan model, a very interesting long-run anchor, the anchor of inflation. Okay, in the very long run, inflation is determined by the behavior of the central bank and or the government, either reacting to being forced to finance deficits or just having an attitude that they want to keep inflation low. All these things can lead to different outcomes, and we see that in the data. But it is certainly a robust fact that over 50 years, countries with high growth rates of the monetary unit or the means of payment have high rates of inflation, and countries that don't have lower rates. It's not a mechanical relationship. You have economic growth, which eats into that relationship, and you might also have changes in velocity because countries move from high inflation to low inflation, okay, or vice versa. The case of Venezuela is always coming to mind. So at the end, I said, this is fine for the long run, but we're actually interested in understanding what happens to Germany in the next year or two, what happens to the UK in the next year or two, and what happens to the United States in the next year or two. So we need to have a shorter run view. And to start, I just gave you this Phillips curve as an example of how we can look at the data for a long time, gather lots of numbers, and conclude that there is something there. Okay, may not be a single bivariate relationship. It might be a more complicated multivariate relationship. But if we gather data and we can at least try to find regularities in the data, this is kind of what Kepler did when he discovered that the planets move in elliptical patterns, or the pattern that planets follow is more similar to an ellipse than it is to a circle. It took a lot of observation to figure that out. And that's kind of what economists have done over the years. So we have the money demand function is a good example. The consumption function of Keynes, even though it's been since refined and partially refuted, and the Phillips curve. And I'm going to take you quickly through the history of the Phillips curve because it's basically a great stand-in for this whole idea of how we get to a theoretical structure, partially informed by empirical facts. Think of Kaldor's long-run growth facts as a way of informing growth theory. Well, the Phillips curve is a way of informing what we expect a good theory to do in the short to medium run. Okay? So, again, macro is about growth, but it's mostly interested. I mean, most people who do macro are kind of fascinated by the business cycle. So, going back to Schumpeter and before Karl Marx, all these people have thought about dynamics over time. And therefore, we need to understand how inflation and output interact with each other, and what are the key relationships. And I'm going to try to get across today that demand and supply is a nice first approximation. So a lot of you won't go on to do PhDs in macroeconomics, but this will be useful to you. Okay, and I've gotten this from MBAs that I've taught. I've gotten this from masters that I've taught who've gone on not to do PhDs, but actually go work in a consultancy, okay? So these are just, it's a little bit like understanding the price of apples and the quantity of apples. It's a little bit like that, okay? And that's what I'm going to try to convey So again, to drive home the point, the original attempts to think about this were inductive. Okay, so it wasn't just Phillips, it was also Haberler and Schumpeter watched the data, or even if you like, the original thinkers, Burns and Mitchell, thinking about how business cycles are similar. They used very interesting tools. They used averages over cycles. Okay, so you can do that to derive inductively evidence to guide your theory. Okay, so the Phillips curve is kind of interesting for us because we still use it. Even though it's been decried and it's been condemned and refuted, it's not really, it keeps getting knocked down and getting up again. Okay, and I'll try to show that. There's an empirical relationship. It's not monocausal. It's also not necessarily linear. But it's a great way of just getting a first cut at the data. And the original guy who discovered this, as I said last week, was really just making a note of this empirical relationship. He was very cautious in his paper in 1958 that we should, before we start using it for policy, we should be aware that it may change. Okay, so Phillips actually kind of anticipated the Lucas critique, if you like, 30, 40 years before the fact. Okay, so there he is. I told you he was from New Zealand. Interesting fellow. I mean, how many of you have operated a cinema? How many of you farmed? How many of you actually herded sheep or hunted a crocodile? And then he went on to study engineering and got a PhD at the LSE eventually. He also was in a prison of war camp, and he got the Order of the British Empire, which is kind of a big deal in the UK. Okay, so he basically discovered this relationship, and as I said, he was more careful, and he was also interested in the relationship of engineering to macroeconomic relationships, and he tried to formulate this, as I said last time, sort of capturing C plus I plus G minus plus X minus Z as a set of fluids flowing through tubes, and trying to capture that dynamic. This is a big deal, and I was told, and I looked up in the internet, there are several of these things all over the world. So if you're in Australia, you can go check out one. There's one in the Science Museum in London, and there are a couple in the United States as well. So this is the context. Economists were looking for something empirical to hook up Keynes's general theory with something that we were seeing more and more after the Bretton Woods system was implemented in 1944 to 46. It was kind of this view that inflation actually could rise. It wasn't hovering around 2 or 3%, 4%. So economists had to deal with this because we knew that inflation has real effects. We saw that with the Kagan model. It can reduce the value of the money in your hands, so you might change your behavior. So Phillips, looked at some old data from the UK and found this negative relationship, and it looks kind of log linear, relating rate of change of money wages in sterling, okay, to the unemployment rate. And the notion was you get this idea of a trade-off. Okay, so this was very tempting for us. And whenever something is tempting, you should be very careful. Right? So the temptation was, look, we have a menu of choices. Economists love menus. We love trade-offs. It's what our bread and butter. You want more of this? You have to have less of this. I can't give you everything. There's always a trade-off. This is why finance ministers are often economists, because they understand that. And it's also that way between present and future. You borrow a lot of money today, you got to pay it back in the future, and vice versa. So this is this was so attractive to economists, this negative relationship. It's not perfect, okay, but it looked like, well, if I'm a conservative politician, I want to protect the owners of wealth and nominal assets, I would rather have high unemployment and low inflation. And if I like the workers, I can just rev up the economy and stimulate it, do lots of government spending, and I can move up into the Northwest Territory. Okay, so that was kind of an exciting time in the 1960s. And you can still see a little bit of that discussion today. I mean, the President of the United States also has this attitude that inflation is not a problem. But if you look at these data, this is the United States in the 1960s. And the Kennedy administration actually thought this was a trade-off in 1961. They said, look, let's go for growth, let's cut taxes, let's have a great frontier, let's land on the moon, let's have a great society. Johnson said, let's have a great society. So all these things kind of revved up the U.S. economy, moving from the the lower right point in the direction of the upper left, but it was kind of a stable thing, right? It looked kind of, okay, so interest rates are rising a little bit, inflation's rising a little bit, but we got got rid of all this unemployment, and people are happy. So moving from 7 to 4%, it's not a big deal, and inflation started to rise. The Vietnam War started to pick up, and the United States started spending a lot of money on military things, and that kind of raised the level of aggregate demand. So we had this view, maybe there is a trade-off, and then Nixon, good old Richard Nixon, was elected president in 1968 and became president in 1969. He said, "Okay, I'm gonna turn down the dial." And he actually said, "We're all Keynesians now." Nixon said that famously, okay? And it was kind of a concession for him because most conservatives don't even like to use the word Keynesian, which means the demand has the first sort of effect on output through just by virtue of the fact that it's moving quickly and people can stimulate spending and get people's incomes up. So that's an old idea. So Nixon said, well, let's raise taxes. Let's have a surcharge on taxes. So that was Nixon's idea. Okay, so I'm going to come back to this in a second. You can see why this is so important because we were able to link up the big three in macro. We have this Keynesian analysis that John Maynard Keynes wrote about in the General Theory that you've certainly seen somewhere. You're going to see it in a little bit more detail, but we're not going to do the basic stuff because you've already done it. We're going to move directly into this notion of dynamic macro models. But the Keynesian setup was explaining Y, and then we needed someone to explain pi, and we needed a labor market to explain U. So those are the big three, right? Inflation, pi, output, Y, and U is the unemployment rate. So we had this Phillips curve, which is going to help us link these two guys together. We're still not done yet. Okay, we're still not quite there yet. But it was a very exciting period in the 1960s. So a lot of people thought we were going to master the universe and get everything going. All we needed to figure out the distinction between, or the relationship between Y and U was not clear. So what happened? Another economist went out and basically discovered another empirical relationship. And I'm going to show you this one for Germany and the United States. It's very interesting. So Okens Law is kind of a parallel development to the Phillips curve relating unemployment to output. Again, this is an empiricism. It's an empirical approach. And Okens Law basically is the assertion that when the economy is growing fast relative to trend, then unemployment is falling. Even though we know in the long run unemployment is kind of determined by the labor market and labor market reforms and the behavior of workers and their employers. But Oken basically discovered, again, looking at data in the 1960s, that fluctuations are almost always associated with movements of unemployment rates and output in opposite directions. So this empirical fact was so exciting that and Oken was at the Brookings Institution, died unfortunately a bit too early. This guy influenced a lot of thought. So you can think of this, and his original discovery looked at changes in U, the unemployment rate, and related that to changes in the growth rate. Okay, so the growth rate is, today's GDP divided by last period's GDP minus 1, or using the logarithmic approximation, it's the log of the ratio of those two. Okay, so this is what happens if you do that for Germany and the United States. Just take each dot in that picture is a quarter in the United States or in Germany. So in one of those quarters, the U.S. economy is really humming and unemployment was falling, and then in other quarters, the unemployment rate was rising and output growth was falling. Okay, you see it also works for Germany. Germany, it's a bit more like a shotgun blast with a bit of a bias, okay, but still there's a slope there, and the slope may have something to do with the fact that when unemployment changes, it may be changing because of long-run changes like policy and not just demand interacting with the economy. So, this is an empirical fact. Some of us may try to recognize something in there that's not there, but back then we saw a negative relationship. If you take trend of output, like we learned from the Solo model, and estimate that for Germany, and then you subtract output from that trend, and then take the percentage deviation from that trend, and then you correlate that with unemployment around its trend, this is what you get. So that's a pretty impressive negative relationship. So relative to trend, even if you can estimate the trend, so German unemployment has been rising up until the Hartz reforms and they started to fall again, the deviations of unemployment around that trend development of unemployment is extremely highly negatively correlated with deviations of output in percent from its trend. So this is another interesting relationship. If I can explain output, in the short run, I can probably tell you a little bit more about what's happening to unemployment. Why? What did Okens say? He said you need people to work in the factories. And usually you need people to work overtime. And maybe you have to hire people on the short to get people to produce the output that people want, what the market wants. Okay, so that's the logic but we have a production function, has to be consistent with that. So all these little, loose ends we have to tie up. That's what the rest of the course will be about, trying to explain how we can still have an Okens relationship. And I wouldn't even call it a law. He called it a law, but it's really more of just an empirical relationship, just like the Phillips Curve is an empirical relationship. This is what macrodynamics is going to be all about. So it's, for 2 decades after Okens and Phillips, people started to think about the macro system just using these simple tools. And macro policy was based on that. But people kind of forgot that these empirical relationships were estimated in a period when there was a gold standard or a gold reserve standard. Does everybody know what that is? That meant that every currency in the world system, this is going from 1944 to 1971, every currency on paper was pegged to gold, but it actually was pegged to the dollar. And the dollar was pegged to gold because the Americans put the dollar in front of all the other currencies. Okay, that was called the Bretton Woods system. And that meant we all had fixed exchange rates. If you went to Jamaica, the exchange rate was pretty much reliable because it was always the same. There were occasional devaluations. So during those periods, inflation was very low, very subdued, because if you have lots of inflation, you cannot keep the same exchange rate. You have to keep devaluing, right? If you have a really high inflation rate, it's kind of embarrassing to be a member of the IMF and have to keep asking for permission to devalue your currency in terms of the dollar. So most countries didn't do that. Occasionally, Germany revalued, and at the very end, the US devalued, and then the system blew up. Okay, so those of you who like economic history, it's really interesting. The world hasn't changed very much, but because economics works, it works. Everybody kind of understood that this is kind of unsustainable. The US couldn't keep running deficits with the rest of the world and pumping dollars into the world's system and then expect the rest of the world to accept these dollars without complaining. Okay, so that was kind of so that's what I'm trying to say is that the Phillips curve was derived under a really great set of circumstances, and the Okens relationship also. So, we have to be careful. There are certain things that may actually fix expectations. That's going to come back to bite us in the end. Okay, so nowadays we think of these things all happening together. That's the modern way, simultaneous equations. But there were people who were criticizing this Phillips curve. And one of those, you should remember, was Milton Friedman. So Milton Friedman, this grouchy but very ingenious economist. I mean, he's grouchy because he was a crusty guy. He was really sort of defending free markets at every pass because I think he always thought they were under attack. But honestly, I only got to see him once, but I always had the impression that he was just doing that to make a point. A lot of people take extreme positions just to make a point. And if you take them into a room and have a couple of drinks with them, they have a different opinion. Okay, so I think this is but Milton Friedman went out on a limb in 1967 in his address to the American Economic Association, and this was like about 10 years before he got the Nobel Prize. Okay, so this is what he said. He said, there is no long-term relationship between inflation and unemployment. There can't be, because unemployment is a real variable and inflation is nominal. It has to do with the monetary unit and how fast the rate of change of prices is occurring and how much the means of payment is depreciating in terms of goods and services. Okay, this is really deep insight. And people said, oh, So he made this speech. He was the president of the American Economic Association, and people thought he was being heretical. Maybe he's just a old crusty guy. And he concluded in a very, very clear way that the trade-off comes from rising inflation or falling inflation. So it's kind of his view was it was kind of almost like the second derivative of the price level with respect to time. So accelerating prices you could imagine, and then he kind of said maybe it's because people don't get it. If inflation starts rising and people don't anticipate it, then sure they're going to work harder. They think they're getting more money, but they're not. Maybe sure firms will produce more goods because they think they're getting more profits, but they're not. So that was the Friedman notion, and it was anti-Keynes. Okay, so Keynes said, in the long run, we're all dead. Friedman said, if we wait long enough, we'll be in the long run. And if you keep doing a lot of short runs, you're going to wind up with the long run. Okay, so Friedman's notion was exactly what our models in the last 3 weeks said. Inflation is a long-run monetary phenomenon. So how do you get from one to the other? We know both of them work, right? We've seen a lot of countries in this past year, that have high inflation, and it's associated with lots of credit and money growth. And we see a lot of countries that have very low inflation, low credit growth, but you also see fluctuations. Okay? So let's go back and see what Friedman criticized. So this is Friedman in 1967 saying, this cannot be a permanent relationship. So he was basically sitting at the point where that arrow is pointing to. Okay, so the paper was published in 1968, and before that it was kind of 3% inflation. Okay, and people said, poo-poo, Milton Friedman. So Nixon in 1969 raised the surtax on the U.S. income tax to make all Americans pay more taxes. This is kind of unheard of, but Nixon did this. He wanted to cool down the economy. That was his logic. Okay, and his logic was, his Keynesian advisor said, we're just going to slide right back down where we came, like a slide. We'll be right back to where we started, and everything's hunky-dory. I'll get reelected, and Watergate won't happen. Okay, well, it turned out he got it wrong, because this is what happened. Okay, the Phillips curve broke down. Okay, you already saw it in 1970. Nixon was causing a recession, and inflation did not fall. So Americans were expecting higher inflation, and they were asking for more wages, and firms were asking for higher prices. So the thing has sort of a self-referential effect going on. And you can see there was another recession associated with the price of oil in 1973-74. And you can see the Phillips curve kind of collapsed. Okay, that's the pessimistic view. So in the 1970s, there was a lot of criticism of this static, primitive-looking Phillips curve. But Friedman himself basically gave us the solution. He said, if you have to control for everything, you have to control what people expect to happen to the price level. And if people have, expectations of 20% inflation, you're not going to be able to pick a point on the old Phillips curve in the 1960s. Okay, because people are going to be automatically asking to get real compensation in terms of the monetary union. So they're going to ask for nominal wage increases that match or even exceed their expected rates of inflation. So the Friedman contribution to this is basically looking at the role of expectations in the Phillips curve. Okay, so in the sense, Friedman said there's a long-run rate of unemployment. The natural rate of employment is associated with being on that solo long-term trend, and we just need to figure out a way to get there. So that's kind of what the rest of this lecture is going to be about. Trying to think about reasons why the short-run deviation of inflation and output from their long-run trends is possible and how it gets corrected. Okay, so we can think of adjustment to this steady state as being part of what medium-term macroeconomics is all about. So Friedman basically said the long run is important. It's going to be the anchor for us. The long-run level of output, think of the Solow model. The long-run rate of unemployment, think of a natural rate of unemployment as resulting from frictions in the labor market, inflows and outflows into unemployment, and then these things will be basically impervious or unaffected by the rate of inflation. Central bankers can choose in the long run somewhere to be on this picture, but they have to be hugging the U-bar vertical line and the Y-bar vertical line. Okay? So this is a great way to think about the UK. The UK had a Phillips curve in the 1960s. We saw it in the 1950s. And then they tried to exploit it, and they basically, it seems to have shifted. There was also some supply side things that were going on. The British welfare system got very generous. I think you can make that connection. And then basically in the last few years, we've seen something more. If you continue this, you see that the Thatcher reforms actually have a little bit of the effect of the Hartz reforms. Unemployment in the UK, despite all their other problems, is around 4 to 5, 6%. Okay, so again, the whole point I'm trying to make right now is that we're going to go back to the undergraduate model of inflation and output and just give you some intuition, and then you'll be able to pick this up and say, wow, I really did learn something for my life, for the rest of my life in macro. And then I'm going to show you, I'm going to trick you into learning about a lot of stuff about stochastic difference equations, because that's the way we can operationalize this picture. That's how we're going to operationalize this relationship. Okay, so there's a long run. In the long run, inflation is neutral, monetary growth is neutral, the output, level of output is restored to its trend growth rate. So every period, think of Y bar is kicking up a few percent. In most countries, maybe 2. In Europe in the last few years, maybe 1.5%, maybe in the US 2.5%, maybe in China 7%, because they're on a growth trajectory. But eventually that will peter out and look like everybody else. Okay? Now, because output is often, do you want to have a system where that thing is moving all the time to the right? You'll leave the page at some point. So we think of the output gap as the right normalization. So we're going to subtract Y bar from output, and we're going to divide by Y bar, so we get a percentage deviation. Okay, that's why we use the caret. This looks like a little hat on top of the variables to indicate percentage deviations from something, from trend. Okay, so this is kind of what we're going to be looking at for the next couple of weeks. We're going to look at how, and I'm going to use a lot of verbal arguments. I'm going to start using math, and eventually we'll only use math. We'll use a micro-founded model to get to this point. Okay, so I have a colleague here who teaches macro a slightly different way, but he uses the same idea in the background. He may not like the diagrams, but the diagrams are there. Okay, a diagram is simply a reduction to a two-dimensional space of things that interest us. Right? One is inflation, the other is the deviation of output from its trend. Okay? So we can get these data. You can go online right now and go to the OECD webpage or the IMF webpage and get an estimate of the output gap. Now, it's an estimate. That means that people who have had a PhD training have gone out and used statistics to estimate or use maybe the Hudrick-Prescott filter to estimate long-run output. Okay, so this is kind of what we're going to do. We're going to look at that moving around over time. And that movement is the cycle. So in booms are times when the output gap is going to be positive, and when it's negative, we're going to call that a recession. Okay, so the ASAT setup is basically about demand and supply. So it requires you to sort things out in your head. What is demand? What is supply? And if you took undergraduate economics, you probably spent a lot of time thinking about aggregate demand. Okay, and the easiest way to think about that is C plus I plus G. And PCA is the primary current account. You can call it NX minus Z. Up to a first approximation, it's the same thing. Germans call it the Außenbeitrag. Okay, so it's the contribution of foreign agents on net to demand at home. So if you want to learn a nice identity, learn that equation, and you'll impress everybody. Anyone you talk to, you can just tell them Y equals C plus I plus G plus NX or PCA. What's more sophisticated is to ask, why does demand call the shots? Okay, in the old days, the Keynesian approach was just, if you increase demand, you're going to increase GDP. Firms always want to produce more. That's the logic of Keynes. Okay, but that's wrong. Firms do not always produce more. Sometimes they raise their prices. Sometimes they just shut down. Okay, so it's a bit more complicated. But the Keynesian assumption would be that firms produce what's demanded. Okay? If you have a view on the supply side, you need to think harder about why firms do what they do. They're maximizing profits. Why do workers go to work? Because they want to earn some money. And is it enough? Or are they going to go home early and drop their pencils? Are they going to put in the extra hours to produce the extra output? Okay, so that's going to give us two views on these two curves. One is, and it's a little bit unconventional because it's, you think about apples, you think of the price of apples, you think of the quantity of apples you demand, and the supply of apples by the apple producers, positively sloped curve. Here we've got the inflation rate, so it's a bit unconventional, okay, but it's convenient. And I'm going to try to explain why the negative slope comes through. And then later on, we'll basically go through models that will get us in a very rigorous way to these curves. Okay, but as a way of a shortcut in thinking about economic relationships at the macro level, this is a pretty useful way to go. Okay, so think about demand first. The demand curve asserts a negative relationship between the output gap, or output, and inflation, and it depends on whether you have fixed exchange rates like we have with France or with Italy, or whether we have flexible exchange rates like we have with the United States. Now, of course, we have both, so you're going to say, well, it's kind of complicated. Well, you always have to take some mixing because we do export and import to both countries. But in principle, you can understand that if you have fixed exchange rates, the exchange rate is not an option anymore. So any inflation differential with the rest of the world causes a real exchange rate change. If our inflation rate is higher than the Italian rate, that means that we have a real appreciation vis-a-vis the Italians. Our goods are more expensive, their goods are cheaper. And that's going to drive NX in the negative direction. Okay? So if you want to write down a function, you can write down PCA as a negative function of sigma, which is the real exchange rate. This is really easy to understand, right? This is macro 1 that I teach in my class. Okay? But that's under fixed exchange rates. Under flexible exchange rates, it's different because under flexible exchange rates, the central bank can choose any monetary policy at once. It's free to choose, basically. And if inflation rises, the central bank will react to it. The reaction of the central bank is what we call Taylor's principle or the Taylor rule, and that has an effect on aggregate demand. So in the central bank, like in the United States right now, Powell is thinking about raising interest rates because inflation is kind of picking up in the United States and the economy is doing very well. Thank you very much. Then it would be natural for the central bank to raise interest rates, and that would cause aggregate demand to decline. So through this mechanism of the central bank reacting to inflation, an open economy or a closed economy would associate an increase in inflation with lower aggregate demand. Okay, so that's kind of the AD story. And I've given you two stories. So if you've taken economics with me or with Lutz, this is easy to understand, but think about this hard because every country is different. So if you're coming from Uzbekistan, you got a different setup than if you're coming from Mexico. Okay, they're just different places, different regimes, different monetary regimes. Very important message. Okay, so then we can think about the supply side, and we'll go into much detail later, but I just want you to understand the supply side has nothing to do, in principle, in our way of thinking here, with what workers and firms want to buy on the market. It has to do with their willingness to actually produce the goods, because if you want to buy something in Germany, somebody has to have produced it. It can be foreigners, most likely it's Germans. So how do you get the Germans to produce the beer that you buy in the club tonight? Okay, how do you do that? Companies have to be willing to do that. The signals have to be right. Factors of production must be available, and they must be willing to do what you need to do. So someone has to go into that brewery and run those assembly lines, 40,000 bottles per minute, whack it out, or maybe per hour, and put it in the containers and send it out. So labor has to work, and capital has to work. Okay, so ultimately, it's going to be the behavior of firms interacting with suppliers of capital and suppliers of labor. These are things you've already encountered in our discussion of economic growth. Okay, so that's kind of what macro is going to be about for the rest of the course now. So I claim that using this very simple framework can help us think about current events. So again, you might be looking for the math. You want to do the math, do the log linearizations. You might also just want to understand what's going on in the newspaper. Right? And this is going to help you. Okay, so this is kind of the inside of Marshall. This is why Marshall still gets a lot of attention today. Alfred Marshall, great British economist. Okay, so it's a diagnostic device. ASAT will help us diagnose a situation in an economy. And I'm just going to assert this, and I'm going to ask you to think about it, and we'll come back at different points in the course and talk about this. So if you see inflation rising, in the same period you see output increasing, this begs for an interpretation. Okay, so in a sense, does it have to do with the people who are asking, desiring, paying, trying to pay for and paying for the goods, or does it have to do with the people who are producing the goods? Okay? No math. Okay, so here's a good example. Here's Germany in 2010 moving into 2011. So these are data, these are real data. Okay, so inflation rose 1 percentage point. For the Germans, that's a big deal. Output increased. Okay, but again, if you're really clever, you'll say, well, in a solo model, we're always kind of growing a little bit, so maybe it's not a big deal. So I need to adjust that. First thing is you have to adjust that picture. Those are constant value euros, 2010 euros, but still it's something that's going to keep growing. So if we wait too long, it's going to leave the page. So we need to normalize that on output at trend. So I'm going to go to the IMF and get their output gap data. Okay, so this is interesting because now we learned that actually in that year 2010, Germany had a negative output gap. Okay, so it was producing below potential. Coming off the Great Recession, Germany lost a lot of output in the first year of the Great Recession. Okay, so we're observing increasing inflation and increasing output, and relative to the output gap moving from a negative number to a slightly positive number. Okay, so what's the best way of thinking about that? Again, not using any math, not using any highbrow theory. It makes sense to sort this out thinking about demand and supply. And the most likely way of getting to that point was a shift of demand along a rising supply curve. Okay, so it's kind of an identification assumption. Those of you who've done econometrics understand that you always have to make an assumption. So one of the assumptions we've made is the demand curve is downward sloping and the supply curve is upward sloping. All right, so I didn't say it was all demand. It's predominantly demand. You might have a supply change going on at the same time, and trying to sort that out requires more information. But again, this is the short-term judgment. This is enough. This goes in both directions, obviously. So if you see inflation falling and you see the output gap increasing, you think you're in a demand-driven recession, possibly. Okay, so maybe look at France or in the next few months, and we'll see what happens there, okay? So the conclusion would be that if output inflation are moving in the same direction, we must be looking at a identified, predominantly demand-driven change, okay? And again, not exclusively. So you're probably saying, well, what, can you actually get it to move in the other direction? And the answer is yes, and there's a great example. I use this example as a motivator. This is Greece in 1989. Okay, moving from 13.7% inflation to 26.5% inflation. Who says the Greeks don't have a history? That's a doubling of the inflation rate in 1 year. Okay, at the same time, output was falling, and according to the IMF, moving from an output gap of 2.3% on the positive side, that is, they're way above trend, and then moving towards zero output gap. So, again, to know more about the German thing, you need to know something about export demand, consumption demand, investment demand. Those are the details. So you need to look for the little items. So what do you look for in the case of supply? What's going on in Greece in 1989, 1990? Anybody want to take a guess? A lot of things are going on in Greece. A lot of things are going all over the world. So there was a, big jump in oil prices because of the Gulf War. And Greece imports a lot of energy. That's a supply shock. Also, the workers started going on strike. There was a lot of worker unrest, asking for higher wages. And I would imagine Greek producers kind of expected higher inflation anyway when they priced that into their own pricing policies. So that's kind of one way of explaining what happened. It's not the complete explanation. There are certainly demand shifts that were possible. Maybe the Greek government spent some more money to keep the economy afloat, because if it doesn't, supply shift can have really disastrous effects. I mean, you can imagine a full-blown supply shock can lead to very high unemployment for some period. So we're going to call that a supply shift. Anytime you have movements in opposite directions. That's just an identifying assumption. And again, it's not an exclusive, it's more of a predominating factor, not an exclusive one. And to do better than that, you got to take econometrics. You got to have some identifying assumptions. You need some extra data. You need more information than just inflation and output. It's not enough. Okay? And that shouldn't surprise you. It's the identification problem. Okay, to summarize this verbally, and then we'll do some more formal stuff. The exchange rate regime is the determinant of why the curve has slope on the demand side. Okay, so the demand curve will be negatively sloped depending on whether you have fixed or flexible exchange rates. And remember, you've probably studied this, maybe you haven't. Somebody has to be doing this fixing of the exchange rate. It's usually the central bank. So if you have fixed exchange rates, it means the central bank is out there every day, every minute of the day, trading foreign exchange to keep it steady. So the Danish central bank pegs the Danish crown to the euro. Okay? At different points in time, the Bulgarian leva was pegged to the euro, or the Estonian kroon before they introduced the euro. At times, the Mexican peso has been pegged to the dollar. So these are policy decisions the central bank has to take, and the central bank has to buy and sell dollars on the open market to do that. So it has to have enough dollars if they're selling, or they have to have a credit line from the United States, which they're not going to get. So they have to have reserves. The central bank has to be ready and willing to do that. China is a good example. China kept the dollar exchange rate very steady for a long time. It never said it was doing that, but it was. Just look at the reserves of the Bank of China. They were exploding. They almost hit $4 trillion. It's a lot of money. Okay, and then when the pressure started to build, they started to, and the exchange rate started to depreciate. The Chinese central bank tried to sell dollars to prevent the yuan from dropping too fast. So under those conditions, the exchange rate is fixed, so the inflation differential with the rest of the world matters. So again, to consider the case of Germany with Italy, if the German inflation rate starts to rise relative to the Italian one, the Italian goods are cheaper relative to the Germans, and German goods are more expensive, so the rest of the world will buy fewer German goods, and that will reduce demand, and the Germans will spend more of their money abroad, which will also reduce aggregate demand for German goods. In flexible exchange rate world, it's completely different. The central bank can do whatever it wants, and it has the Taylor principle, and that kind of gives us the slope. But the reason for the slope is different. So again, without going into detail, if you do this for a living, those curves that we looked at have slopes, and the sensitivity of those curves is depending on different factors in the economic system. Okay, so now I'm going to turn on the mathematical switch, and we're going to try to summarize those curves in a static way at every point in time, and then let the position of the curve shift. So we'll think of the intercept parameters, or if you like, the constants in these difference equations, or shocks, as determining the position of those curves over time. So if you allow me to do that, I can actually trace out lots of interesting patterns of adjustment. Right? But it turns out that the discipline of economics makes us think about these patterns of adjustment in a rigorous way. Okay, and if you do more advanced courses, you'll do that. So I'm going to use linear difference equations to operationalize these relationships. I'm going to write down a set of linear difference equations, and I'm going to solve them, and I'm going to make the Slutsky point. And I told you this really brilliant Russian Eugen Slutsky, Eugen Slutsky, Eugenio. I mean, he published one of his most important papers in Italian. And this guy was a pretty incredible guy. He's all over the world. And I think he actually got arrested and put in a gulag at some point. They wouldn't let him publish his papers. So, you know, the idea of Slutsky, this vision, is that we have this stable set of relationships that gets shocked. And the shocks propagate through the system and give us induced cycles. And these cycles have not only characteristics for each individual variable, but have implications for the co-movement of the variables through time. Okay, so And again, we already saw some co-movement that's interesting. Okens Law, for example, or the Phillips Curve. Those are interesting co-movements, right? And then we need to ask what shocks are moving the system around, and shocks happen every day. So we have Brexit today. Next week we might have Macron, and then we have Trump. All these, and China. All these shocks keep hitting the economic system, and they accumulate, and they give us a business cycle. That's the interesting idea of Slutsky. And I'm going to show you that, not just formally, I'm going to show you that using a simulation. Okay? So what is the behavior of the system when it's at rest? That's the steady state. That word has already come up. Steady state is a concept for you. Imagine a world where there are no shocks. What does the system look like? It's at rest. And then we start shocking it. And again, by construction, I can try to offset the shocks, but I have to recognize them first, and then I have to do something about it. So policymakers and politicians can't do anything about this. And they can't do anything about Brexit. It's going to happen, right? Or maybe it won't happen. Maybe we'll all get shocked again, right? And German companies are freaking out because they've made investments in the UK, and they don't know whether they should shut it down or not, okay? So no matter what happens, it's a shock to somebody. So the world consists of these disturbances, and our objective should be to think about consistent ways of explaining how the shocks are propagated through the system. Okay, so here's a toy version of the ASAT model for your pleasure. Okay, so I'm going to think of aggregate demand, and I'm going to think of a closed economy. So forget the exchange rate. We're just talking about the United States or Japan, big old China, big country. Imports and exports are we're just going to put that on the side just to fix ideas. And I'm just going to write this system down. Again, this will look like something you will derive rigorously later on in the course. Think of Y bar as the deviation of output from steady state. Think of I as the interest rate. Think of pi as the inflation rate. Okay. So that would tell me that A2 probably is negative. If the real interest rate goes up, output goes down. Why? Because aggregate demand goes down. Aggregate demand goes down because investment goes down, consumption spending goes down. And D is a shock. So D is a demand shock. This is like the Germans are in a great mood and want to spend money this Christmas, and it's much more than it was last Christmas. Okay, that will have an effect on the economy. And it will have an effect that doesn't just last one period. It may actually last several periods. Okay, the second equation is something like a Taylor rule. Again, this is just an example. I mean, I want to stimulate your thought about this. Okay, and then we have the second equation is the Phillips curve. The Phillips curve has been augmented following Milton Friedman. So think of pi tilde with the curly Q on the top is what people expect inflation to be. So think about it, this is just the rate of inflation people have come to expect. I'm not going to say that it's rational yet. It's the next step. I'm going to say that's just what's there. So we need to explain that. This is called core inflation. Some people like to call it inflationary expectations. Okay, that's the second relationship. And the third relationship is the explanation of core inflation. Okay, so that's the rate of inflation that agents actually expect. And in the old days, this is what we used to do. We used to write down inflation as a function of lagged values of inflation. So people, they saw inflation in the past, they looked in the rear view mirror and they saw inflation rising, so they started expecting more inflation. But they never got ahead of the curve. Okay, so this setup, and this is just a toy version to get you thinking, lets people get ahead of the game. So if lambda is very close to 1, then agents are very close to getting it right. And you can imagine if you live in a country like Venezuela and you're trying to negotiate for something in the local currency, you better get it right. If you make a little mistake, it's a huge mistake for you. It might be like a quarter of your wages in purchasing power terms. So the notion here is that this lambda captures how forward-looking or rational, if you like, or how much foresight people have on the inflationary development in the current period. So think of this, this is what people use to think about their own wage increases. So the Phillips curve is supposed to be a relationship between the way prices are set in the economy. We'll derive that in detail later. But it's also affected by the amount of sort of excess demand in the economy, how much demand exceeds zero in terms of the gap. So think of Y as the output gap. And then S is our supply shocks. These are things that shift the supply curve, holding everything else constant. Okay, so you see we've already got a closed system. This is a system of 3 equations and 3 unknowns, given the past. So given values of inflation, interest rates, output, core inflation in the past, I have 3 equations and 3 unknowns. It means I can solve it. And if I can solve it for this period, I can solve it for the next period if I know what the forcing variables are. The forcing variables are the exogenous variables. Okay, so I need to know what the shocks are. I need to know what demand shock was. I need to know what the supply shock was. And then I can go to town. This is a simple way of reducing a huge amount of complexity in the economy to these factors. Now, again, demand can be lots of things, and you need more information. Right now, I'm just calling it a shock. Same thing is true of the supply side. Yeah. Yeah, lambda in this model, this is a model, okay? So you might say people get smarter, maybe they go to grad school and learn how to anticipate inflation better. Lambda could change. Maybe lambda is a conscious decision of economic agents. Maybe people use machine learning to figure out what inflation is. That's all possible. But right now I'm taking it as given. It's a parameter, okay? So it's kind of and again, it can't be equal to 1, and it can't be equal, we don't want it to be equal to 0. People are not completely stupid. Maybe maybe they're using Bayesian learning. And if they use Bayesian learning, they always use the past to help predict the future. So, and maybe this lambda is changing. If they're using Bayesian learning, maybe lambda is changing, or it's not constant. So there are all sorts of ways, bells and whistles you can put on this in this setup. But again, the idea is to convey the geschlossene Einheit. We have this closed system. And we can use this, we just put the shocks in and we get these data coming out. So that's kind of where we want to go. So even if you do a complicated DSGE model with explicit consideration of the supply side, firms maximizing profits, fixing prices, using the Calvo ferry or cost of changing prices, all these things are going to give you something like this in the reduced form. Okay, so again, if you can get, the reason I'm showing this toy model is to show how we get difference equations and how the difference equations induce dependence on the past. Okay, and how Slutsky is the hero of the day. Okay, so here are the variables defined. And for simplicity, we're not going to have any monetary shocks in this model. So you might think that the Fed or the Bank of England or the European Central Bank also is kind of shocking. Right? So you could think, maybe, I don't know if did you guys hear that the OIHG just ruled that the open market interventions of the ECB are okay. There was a bit of uncertainty, right? They could have said this is illegal. The ECB did not have the right under European law to buy debt on the open market. Well, they just ruled that it's okay. And the German Verfassungsgericht didn't want to deal with it, so they kicked it up to the OIHG, the European Court of Justice. So, why do I tell you that? Well, it's another type of shock, right? If the central bank suddenly wants to cut interest rates and no one expected it, that's a shock too. Okay, but you can put that in. You can put it in right here. You could put another shock in right there, and you could solve the model, all the endogenous variables as a function of these shocks, including the interest rate shock. Okay, so if Powell decides to raise interest rates by 100 basis points tomorrow because he's in a bad mood, shocks the markets, everything sort of collapses, the model can take care of that. We can handle that. Okay, so now let's try to solve this model. Let's try to write it down, write the endogenous variables, and I told you there are effectively 3. Output as a gap, inflation, and the core inflation rate. Those 3 as a function of exogenous and predetermined variables. Predetermined means their own past values. Right, so past inflation might have an effect on my current inflation in the solution to this model. It's linear, so we can do this. We're going to have closed forms, and we call them reduced forms because we're reducing an expression of the endogenous variables as a function of the stuff that's predetermined or exogenous. So I'm going to do this very slowly so you can understand what I've done. It's just solving, right? You can do this using matrix algebra. It's easier, okay? But I don't want to push you too far at the beginning. It's something everyone knows how to do, right? You use matrix algebra to solve systems of equations. You can do that. But right now I'm just going to just do simple, you know, Germans say herumfummeln. I'm going to play with these equations a little bit. So first I'm going to substitute core inflation out of the system. Okay? And then I'm going to, because lambda is not equal to 1, I can do that. Lambda is less than 1, so I can divide. So you can see that already I have a very interesting relationship. Inflation, its own lag period, lag and the levels of the output gap and the supply shock. And they're kind of magnified by this 1 minus lambda factor, okay? So now let's take the AD curve. Let's first difference it. Let's just lag its previous value, okay? And you get the following, the second relationship. And now I can take the first relationship and substitute it into the second, and I can basically get the following. A second order difference equation of the output gap in terms of itself. Okay, second order difference equation means it's linear. We're talking about linear second order difference equations. Output as a linear function of its lagged value and its twice lagged value and a shock. This shock is a mongrel parameter. It's a mix of many different shocks. It's basically everything put together. And without more information, we're not going to be able to say much. And that's why dealing with reduced forms is always a little bit dangerous, but at least it gives you the point that basically a shock to output today, coming from any of those, you'll see what the expressions are for this in a second, will have a direct impact effect on y, but this effect will continue into the future because yt is bigger. In yt plus 1, yt is the lagged value, so it's going to have an effect on yt plus 1, and it's going to continue to propagate into the future. Okay, so if we take a closer look at this stochastic difference equation, we're going to learn a lot about how macroeconomic shocks are propagated. Because each of this alpha 1 and alpha 2 are functions of all the variables I started with. A1, B1, lambda, A2. Okay, so this alpha 1, alpha 2 are reduced form mongrel parameters, we say. They're not, without more information, you're not going to be able to say much about them unless you have the original model and you can solve for these. But the point I'm trying to make right now is that these alpha 1 and alpha 2 express a relationship, a dynamic relationship of current output as a gap to the trend with its past value and its twice lagged value. So it's even better than a first order difference equation in the sense you have a richer type of dynamic structure that you can pick up. Okay? And it's not an AR3, it's not a third order, it's not a fourth order. The way I set up the model before, so if you go back, that model gives rise to a unique reduced form for output. And it also gives a reduced form for inflation. You can write a pi equation as a function of lagged pi and twice lagged pi. Okay? So this is another interesting aspect that we won't spend much time. I want to teach you about this difference equation because it's interesting. Why is it interesting? Because these coefficients are not the whole story. These coefficients are functions of the deep parameters. Okay? And those expressions are kind of nasty. Not expecting you to memorize them or anything, but it wants to signal to you that if something happens in the economy that changes one of those underlying parameters, it will change the reduced form behavior of the system. So we call this the Lucas critique. Suppose we thought that, as you said, lambda was depending on people's learning behavior, and therefore it responded to economic incentives, then certain types of interventions may cause people to change their behavior and change the alpha 1 and alpha 2. That's called the Lucas critique. Okay, we have to think hard about what gives rise to those A1, B1, C1, lambda. Okay, so it's too easy for us as economists just to write down a model. It should be better. We should do better than that. We should have a motivation that comes from microeconomic theory, for example. right? So we should be thinking hard about first principles. Why is the aggregate supply curve upward sloping? Is it because firms set prices given wages? Is it because workers set wages given prices, or some mixture of the two? And how, most importantly, how do they figure out the future? What is determining their expectations of future realizations? Okay, so take a good, careful look at these, and then imagine what would happen if lambda got really, really small. Or what would happen if lambda got really, really close to 1? What would happen to these reduced form coefficients? They would change. Okay, so understanding the model, understanding this implicitly, or actually explicitly, requires understanding the structure. And you have to have faith in it. Okay, so this is where a lot of people part company. They say it's enough just to do the first part. And a lot of people say we need to spend a lot of time theorizing about those deep parameters because of the Lucas critique. Okay, but don't think about that yet. We're going to spend the rest of the semester talking about how we can get a better view of these coefficients. Okay, so believe me, you could spend much more time. There's a lot of stuff we could put into this model. The point I'm making right now is that if you look and focus on this thing and assume that people's behavior is stable, I just want to see how the system reacts to a shock. So I'm going to feed this equation with epsilon, a certain set of epsilon. Every period, I give it a different epsilon. And I'm going to take it to be white noise. What is white noise? White noise, mean zero, serially uncorrelated, identically distributed variables, random variables. Identically and independently distributed random variables. So I'm going to take this as the stuff I'm feeding into the model. So it's my input. Okay, so these are the shocks. And why am I doing that? I'm just trying to show you that I don't have to cook this model to get a cycle. Okay, the structure of the model will naturally give me cycles, even if it's acting on random stuff that cannot be anticipated by construction. Okay, so I'm not assuming that the demand shocks are serially correlated. I could do that. I'm not assuming the supply shocks are serially correlated. I could do that. I could do a lot of stuff. I'm taking white noise and putting it into basically the previous model. So I'm taking it for every t from 0 to 50, I'm going to put in a value of epsilon, and then I'm going to let the economy act on its own past. The idea is simply that in period 0, if I shock y, y1 will be affected by that shock by virtue of this equation. Okay, so you have to buy that, right? You have to buy into this idea that it's a propagation. So what happens if I feed this into my model? I get the following series. I get something that looks like a business cycle. You can go to the U.S. GDP data or the German GDP data, take logarithms of those data, take the deviations from a trend, estimate it any way you like. You're very likely to do best estimating an AR2 process, regressing current GDP on 1 lag, 2 lags, and a constant. Okay? It has a pretty good fit. Okay? And basically, this is kind of what the rest of the course is going to be about. What kind of models can give me a decent looking cycle? Not just that, but also the variables move together, right? If you look at the data, inflation and output don't really move always together. Sometimes they move like this. Sometimes they move like this. Sometimes they're correlated positively. Sometimes they're correlated negatively. Sometimes they're not correlated at all. So different periods of time are characterized by different correlations, which makes sense if you think that the world has many different types of shocks: supply, demand, monetary policy. Okay, so that's the and notice if you're interested, those are the original parameters I put into the model to get that result. So you can do this on your own if you want. Just get a spreadsheet, call up a random number generator, a pseudo-random number generator, and just feed it in there and see what happens. And the really cool thing is you can tweak around with alpha 1 and alpha 2 and get different cycles. You can get cycles of different frequency and different magnitude. Okay, so that's the lecture next week. We'll actually deal with that in more detail. So why, the structure of the model gives us this reduced form, and no matter where the shocks are coming from, it will generate some sort of cycle. And this is one that I just put in and got this nice looking cycle, which looks kind of like a cycle. I mean, the periodicity is about 14 to 20 quarters, which is like what we have in most OECD economies, maybe a bit longer. So Robert Lucas wrote this incredible sentence in 1980, a long time ago. He basically said, we should move towards thinking about rules, behavioral rules, and policy rules. So one reason we have the Lucas critique that you've learned about in the past is Lucas was criticizing being blind about the alpha. You need to understand where the alpha comes from and be sure that it's robust to policy interventions, and then let's see what happens. So, if my alpha 1 and alpha 2 that I get from these coefficients is robust, then I could think about policy. But if I can't think about that carefully, I'm going to be subject to the Lucas critique. So Lucas basically said we need to write programs, we need to code these rules and feed them with different types of shocks and see what happens. Right? So this is and you're probably asking, what is Fortran? Fortran is like C++, but back then Fortran was really fancy. I use Fortran. Lucas making the statement is a warning. We should think hard about what goes into the alpha 1, alpha 2, what goes into the A1, B1, A2, C1, and all the other stuff. That's kind of what it's all about. So again, Slutsky's vision, economic theory is a way to construct a black box. So think of alpha 1, alpha 2 as the black box being fed by these shocks. And Slutsky's vision is that what we observe is accumulation of these random shocks over time. So you can think of it as a transform or transformation of IID shocks into irregular shocks, and I've shown that. So the big question for us is, how permanent is the culmination? How long does it take? Will it eventually be worked out completely? If I just shock it once, okay, not every time. So in the previous example, I was shocking this every period. But now we could ask the question, what if I just shock it one time? How long will it take for that shock to die down? Will it die down? Okay, is it explosive? Well, we know it's not going to explode because we're looking at deviations around trend and we haven't seen an explosion yet. Okay, so we'll be restricting our attention to stable models, but we still could ask, what happens if I give one shock and look at the so-called impulse response of the system? How does the economy respond to that impulse? So that's kind of what we're going to do next week. We're going to look at the accumulation of the shock. How long does it take for a shock to work its way through the system? And we're going to ask, what conditions do we need to make sure that it doesn't explode? Okay, so these are like really technical things. And then we're going to ask, is there something I can say about the roots of the system? So the difference equation has characteristic roots. You can show that's kind of related to an eigenvalue of a certain matrix that summarizes the same dependency. So if you like eigenvalues, you can do it that way. What kind of conditions do we need to guarantee that the system is stable? And can I say something about how long it will take for the system to reach maybe 1/2 of its long-run value? These are really important questions. For example, think of the United States right now. The U.S. economy has been shocked by Donald Trump. Literally, okay? Huge increase in defense expenditures, huge cut in taxes, big investment, in stimulus for investment. I'm not sure how much investment has boomed, but it has gone up. So these are like shocks. And the question is, how long will it take for that impulse to sort of die down? Okay, it's not trivial. It's not a trivial question to answer. We need a lot more information. So in the end, we've got something like this. For the rest of the semester, and I think I'm just going to stop because you should probably absorb that. But next time we meet, we're going to take the details of this difference equation system seriously. We're going to solve for the characteristic roots of the system. We're going to examine how close they are to the unit circle, and they can also be They can be complex conjugate numbers. Okay, so I don't know if you want to go home and open up your high school math book again and check what that is, that's an important notion. Okay, so the dynamics of these difference equations can be characterized by the presence of complex conjugate roots. And if you have those, that means that when I shock the system one time, I'm going to get a cycle. I'm going to get a damped cosine wave, effectively. Okay? So, you say, so what? It's not enough to show the irregular cycles before. Okay? Because you can have a system that has no complex conjugate roots and still get something that looks like an irregular cycle. But the question would be here, shock the system one period, what happens 50 periods out? Have we crossed the origin many times? Have we crossed the zero value many times? And we'll proceed from there. Okay, so I went a little bit fast. I'm done. And have a great week. And be prepared for complex conjugate numbers when we meet again next week.